Excellent. Thank you, Haley. So you can see here who you're going to be hearing from today. And you can see this is really important if you're new to TBR. These are the analysts, which analyst covers which vendors. And that's important to me because that reflects how we see the market, how TBR approaches things. Every single analyst has a set number of vendors that they look at. You'll be hearing from all three of them, but I want to encourage you, as you look at this now, if you have questions based on what they say during the webinar, or if you have questions about the specific vendors that you now know that they cover, feel free to throw those questions into the chat and we'll get to them. We'll leave plenty of time at the end for that. One other thing that I want to start off with, we've been doing this lately in a lot of our webinars. We just want folks to understand right away what the key messages are that we're going to cover over the next 45 minutes or so. So, sort of if you walk away now, please understand this. First, we think a blockchain's adoption curve, it's not about the tech, it really is about the people. Secondly, we're seeing sustainability services as they grow really revolving around what are the measurable metrics that we're all already familiar with. So those metrics that we now know and maybe love, maybe hate, but sustainability is really going to be about going after those kinds of metrics that we all know. And then third, the trends that have been driving IT services, we think in the last couple of years, we think those trends are going to continue to drive the market. That sort of puts us in a little bit of a holding pattern here when we look at the broader IT services market and try and understand what's happening. Part of what we're seeing is just kind of things have been the way they have been for a little bit now, so that sort of sets us up for either some dramatic change in the near future or a lot more of still the same. Okay, this is what we're going to cover, pretty much the same order as I just said on the last slide. We'll talk about blockchain, we'll talk about sustainability, and we'll talk about IT services. I also want to point out that we're going to cover a bunch of vendors, including some more detailed assessments of the ones that are listed here below. We'll get to that once we go through the blockchain and the sustainability part and we get into IT services. So before that, I want one more thing before we jump into the depths of it here. We are covering these issues relentlessly. This is a recent screenshot of our website and our most recent special reports. I can't read it from here, but I think that says May 2nd on the Kindle report. So that was just a few days ago, earlier this week, that we released that. We do quarterly reports on most of the vendors that we cover, and we do semi-annual reports on the privately held firms. And then we do both quarterly and we do semi-annual benchmarks. But these kinds of special reports come when we have some analysis or some opinions that we want to share sooner than we do on those particular schedules. So I highly recommend checking these out, and then you can reach out to the analysts directly who wrote them if you have any further questions. So let's go ahead and the first thing that's going to be on our list is going to be blockchain. And with that, I will turn it over to Boaz.
Thank you, Patrick, and thank you everyone for joining us today. So I don't want to spend time on reading over each column, what's on this slide, but what I'd like to provide is a little update on our view on the blockchain market. And this table actually comes right out of the most recent blockchain market landscape, which is published at the end of April. And as Patrick pointed out a moment ago, what we're seeing in terms of adoption is the blockchain winter is ending, and really we see many vendors starting to spring into new opportunities that are closely tied to digital transformation programs, rather than being sold as a standalone vehicles and standalone tools that may work or may not work. Certainly, there's enough hype out there around Web3 and Metaverse that are increasing the opportunities for use cases for blockchain. It's inevitable. Blockchain, the potential for disruption of the standard business models and exceptionally long-standing and profitable revenue streams, such as audit and accounting, lead us to believe and to see more opportunities across the wide spectrum of those digital transformation engagements and use cases. As I mentioned, the technology has begun to mature, but it's still, despite the people side of the equation, that is a little bit unsteady, so to speak. That's still the problem. The people are not the problem, and the technology is not the problem, but the people often are. As an increasingly core element of digital transformation, we do believe that 2022 will be a pivotal year for blockchain. The consultancies and IT services vendors that have invested, have built experience and trust, can apply use cases that will increasingly differentiate into a top-tier class of blockchain and digital transformation providers. So a little bit kind of pivoting towards why we have this information on the slide here. The ebbs and flows of the blockchain adoption have often led to questions about the readiness of the technology from the technology standpoint, right? Which enables the conduit for the building the business use cases. We recognize that the blockchain ecosystem is large and rather noisy in terms of vendors that are trying to capture stakeholders' attention and investment budgets. Standing out in the crowded space is not an easy task, and the first mover advantage often pays off, but also comes with a fair amount of risk. So the three blockchain platforms that we see as currently as leaders across the various use cases are R3's Corda, Ethereum, and Hyperledger Fabric. And that's kind of the core of the blockchain market landscape discussion that we just published in the end of April. R3, for those of you who may not be familiar with, was founded back in 2015 by David Ruther, whose background at Wall Street really provides him with a deep understanding of the financial services markets. And the company's Corda platform has increasingly become the de facto private blockchain platform, although it was initially designed not as a blockchain, but as a distributed ledger for clients with within heavily regulated industries like banking and financial services and capital markets. At the same time, continuing that discussion, Ruther's vision was largely shaped by a market gap that was created by the Hyperledger Fabric, which IBM was largely heavily promoting at the time R3 was launched. While at its core, Hyperledger is also a private blockchain, just like R3's Corda, the technology is perceived as enabling a slightly more horizontal approach, allowing the enterprises to develop blockchain-based projects through a plug-and-play type of setup, with best of known a use case stemming from the IBM's collaboration with Walmart around supply chain optimization. While the open source modular approach of Hyperledger Fabric acts as a good foundation for blockchain use cases, the lack of use cases has somewhat scaled back adoption, particularly for that platform. It's also the support that we're seeing as a gap in support from IBM and others around Hyperledger Fabric. On the contrary, the hype around the most known public blockchain, Ethereum, has galvanized attention from stakeholders across the ecosystem within the past 24 to 36 months. The launch of Ethereum has completely different vision and purpose. Launched as an alternative to Bitcoin, essentially back in 2013, the Ethereum's co-author Vitalik Buterin had a vision for basically the blockchain for the masses, which continues to serve as the foundation of the technology as a use case scale. And despite some of the co-authors of Ethereum, more commercial view of the opportunities that have enabled by Ethereum. So they're trying to, in a nutshell, Ethereum is really about the common good, the do good, so to speak, enabler, versus some of the co-authors outside Buterin who want to commercialize and see how it can fit in the enterprise adoption. The pros and the cons of using any of the blockchain platforms really fall largely within the user's preference and the development of scalable use cases we talk about. While the hype around cryptocurrencies continue to drive awareness of Ethereum, the anti-establishment sentiment of many of its developers, including some of its co-authors, have raised concerns about the platform's acceptance and deployment within the large enterprises. Additionally, the so-called gas fees, which is kind of a good link here to think about the sustainability topic we're going to talk in a moment later, which is the energy cost to mine and manage crypto, appear to be rather high, which have raised questions around the platform, especially the sustainability and decarbonization discussions dominate enterprise buyers' investment agendas. With Ethereum addressing the higher energy costs to develop an Ethereum 2.0 by pivoting essentially the consensus mechanism from what they call proof of work to proof of stake, where the former requires higher number of transactions, with a higher energy cost. The latter allows miners and stake native cryptocurrencies to become validators. And the platform is moving a step closer to appealing to a broader audience that is aiming to use it and implement a green-friendly solution. So I think the first step for Ethereum before it gets adopted and technologically ready for the enterprises be more of a green-friendly, because that's the top of mind for many of the stakeholders within the ecosystem, especially on the enterprise side. So while the TBR is aware of some pilot projects and recognizes the need for collaboration between Ethereum and Hyperledger, as well as Ethereum and R3 Corda, there are yet to be any tangible go-to-market efforts. We know there's a lot of kind of middleman vendors with API kind of connectors that are trying to build up more of that readiness and the plug-and-play in the existing IT architectures, but it's a long way to go. But it's certainly enough awareness to start to see some investments. Couple other things to highlight here for those three platforms. We know that, like I said, R3 is very much financial services, but when it comes to opportunities elsewhere, we know that they do partner well, and they're ready to ask their partners to lead the way in non-financial services industry opportunities. At the same time, similarly, Hyperledger needs more partners to really scale up adoption beyond IBM, because IBM, we know, has been focused largely on the cloud in recent times, and the recent split between IBM and Kyndryl has shifted priorities from a corporate standpoint. Ethereum provides most promising outlook as long as vendors overcome the privacy concerns that come with using public blockchain for private and business level transactions. So that's the big opportunity. So as long as Ethereum or any of these partner ecosystems are able to address that privacy concern, that we can see that Ethereum becoming kind of the de facto platform for enterprises moving forward. Managing the partner ecosystem obviously lies at the heart of successful blockchain deployment, providing opportunities for consultancies and IT services vendors with broad enterprise level trust to shepherd the community participants. That's something that it's in the core of a scaling adoption for blockchain. Additional opportunities for IT services vendors revolve around custom application development, user interface intuitive solutions, especially as backend communication between the nodes, as well as the core coding for Ethereum specifically. Supporting smart contracts requires highly specialized skills in the language is called Solidity, which is resources are, with skills in Solidity are scarce, so it makes it much more challenging. So it's again a noisy ecosystem with a few leaders that we have identified, with things like Ethereum probably potentially winning the race into in the enterprise, but again coming green ready and enterprise ready when it comes to privacy. Those will be the big issues, and obviously maintaining that foundation about blockchain for the masses. As long as one of the co-founders is okay to be at the enterprise level, then things could work out. So maybe we can move on to the next slide and talk a little bit about one more use case when it comes to blockchain, which is the CBDCs, or central bank digital currencies. The map here is from a collaboration between the World Economic Forum and Accenture. It's probably like a 6-month-old map, but I want to kind of put it as illustrative purposes to show where the different governments are in terms of their journey when they think about crypto in a sense of central bank digital currencies. We provided some initial analysis on the CBDCs as they pertain to the DeFi, centralized finance, in our previous blockchain market landscape back in October. And we'll continue to collect and analyze data and insights around the topic. But meanwhile, a couple of developments emerged since last October, so it was worth for us to bring it up to everyone's attention, including the recently published paper by the Federal Reserve Board focused on the CBDCs, and in particular the digital dollar. The U.S. Security and Exchange Commission's approval of the Boston-based exchange that will use blockchain for faster settlements and potentially enable exchange tokenized securities. And lastly, President Biden's executive order on ensuring the responsible development of digital assets, including CBDCs. So here in the U.S., I mean, just for a moment here, the U.S. government's awareness and initial interest in CBDCs are a step in the right direction, the way we see it, towards recognizing the implication of digital assets for the economy and everyday consumers. However, given the complexity, particularly around reaching consensus among community participants on the governance side, we believe it will be a while before the U.S. digital dollar will be deployed at scale for everyday merchant transactions and trade. The implications between the wholesale and the retail CBDCs certainly carry the risk, the scale, speed, and obviously the rewards whoever is ready to invest in. Connecting the Main Street and the Wall Street economies through blockchain is a necessary step that we believe will have a bigger, broader impact on enterprise buyers' digital transformation initiatives. One might see such framework a bit of a long shot, but historically we know financial services institutions have paved the way in new technology adoptions. Additionally, with many international governments showing interest, and as shown here on the map, from a researching the digital dollar project in the US to experimenting, co-implementing like the digital yuan in China blockchain, we believe the technology will gain further support among buyers enabling the digital transformation. E-commerce and telecommunications likely be the next two industries vertical ripe for adoption. Just to kind of wrap up the blockchain discussion, blockchain platforms like Ethereum or R3 Corda can start expanding the addressable market and become the blockchain platforms for the enterprise. Just as SAP gained their position within the ERP market back in the 90s, provided leaderships recalibrate their vision beyond either financial services for the R3 situation or blockchain for the masses, and also account for the evolving partner ecosystem requirements. So there's a huge potential, but leadership and culture lie in the core of scaling further adoption. So with that, we'll turn it over to Patrick.
Yeah, thanks, Boz. And I want to point out three things before we move away from blockchain. Based on what Boz just said, we've for a long time have talked about when it comes to emerging technologies, when it comes to IT, when it comes to consulting, that really the technology is not the people, not the problem. The people are the problem. The way Boz said it a few minutes ago, where the people are unsteady, and I think that's a more nuanced, it's a better way of looking at it, is that it's just an unsteadiness, particularly around blockchain, Web3, all the emerging technologies. And what that means is that you really do need use cases to help steady people. Use cases are stories. People like to hear stories. That's how people understand things. So that's sort of the people side of it. I do think something else Boz said was really important, and that's where when we look at IT services vendors and consultancies, it really is their ability to manage the partner ecosystem. We personally at TBR, professionally at TBR, honestly, flat out don't care about the technology part of it. We care about what they can actually do, and what IT services vendors and consultancies can do in the blockchain space is provide that management of the broader partner ecosystem. One other thing I'll say on blockchain before we're done, in about a week and a half, Boz and I are going to be at an EY blockchain event in New York City. So in I guess 3 weeks or so, look for something from us about that event and to see if we've changed our mind on anything that Boz just presented there. So I know I said it at the start, TBR focuses on vendors first. That is true, but our first two sections today are actually looking at broader issues and technologies and opportunities across the whole market. So the first was blockchain. Now we're going to turn to sustainability, and we'll go back to Boz for this one as well. Boz?
Sure, thank you. So the two graphs here on this slide particular come from our digital transformation voice of the customer that published last November. And as part of that research, we typically add a module. And last time the module was focused on sustainability. So we're trying to better gauge the readiness, the awareness, the budget kind of like appetite for spending on sustainability from enterprise buyers that we survey across the globe. So a couple of highlights here. As you see, there's definitely a fair amount of a budget being dedicated to sustainability. And also there's the expected change is across the board, right? So kind of like it's not surprising in a way that to see those results, but it's also encouraging, especially as it's not just a talk in a news cycle as may have happened in the past, but this time it's coming to look more for real. And we know that there's some new regulatory requirements coming down the pipe from SEC and then the European Union that will compel vendors to be more compliant in their reporting standards and so forth. So the relatively even split of the sustainability budgets, really it's got a promising message for all the sizes with a diversified portfolio offerings. Over the 3/4 of the respondents are planning to increase their budget for sustainability over the next year, which will create those opportunities for vendors that can tie the digital transformation program outcomes to sustainability results. So again, just like blockchain, sustainability needs to be attached to a digital transformation program rather than being sold as a standalone. We believe that a part of the increase around sustainability spend is also coming from the savings that buyers have generated as a result of implementing automation and cloud-enabled services, reducing the total cost of ownership. So budgets are somewhat steady, a little bit increasing, but they're kind of shifting budgets essentially within the enterprise. While the time and material contracts are the most utilized pricing structures, which is not surprising given the nascency of the investment and the fact that they tilt the risk to the vendor, outcome-based engagements are quickly closing the gap. So that's from the commercial standpoint. So as the latter demand better collaboration from pre-sales through execution and renewal cycle while ensuring service level agreements are met. So kind of a very typical roadmap for execution and partnership on the commercial model, But again, the appetite is there, the budgets are there, so we're starting to see more and more opportunities being evolved, and we're hearing more use cases in the marketplace from vendors and buyers as well. So maybe we can move on to the next slide, which is again another graph from the same research, and kind of like what's driving that behavior, which I started talking a moment ago. The most surveyed buyers really expect the services to help them gain competitive advantage over their peers, which typically occurs with new initiatives, as they often provide a guiding light for executives to tout among stakeholders. While a bit more of a third of the respondents see investing in sustainability as a way to create healthier working conditions, caring for their environment ranks towards the bottom. Caring for the environment ranks ranked towards the bottom of the list, suggesting this trend could be a short list, much like the way the HR and employee experience transformation went from number 3 at when the first pandemic hit as an objective for digital transformation to the bottom of the list in 2021. So very careful to see how well vendors capitalize on the opportunity, because budgets can quickly shift back and put sustainability as a less of a factor that's caring about the environment or the employees, but more something that is becoming a ubiquitous framework. So we see also the fiscal related benefits, including improving financial performance, as well as taking advantage of the government-backed tax incentive programs as the KPIs that will stick in the long run and will continue to motivate buyers to invest in sustainability services. This, however, will pressure vendors to demonstrate some more tangible results, and services providers that can shepherd relationships with those community participants, including public sector agencies and commercial buyers, are certainly well positioned. As sustainability is it's not a new idea, as we talked about a moment ago, and has fallen out of favor in the past. So now it's up to the vendors to capitalize. And with that, I'll turn it over to John to talk a little bit about some of the vendors that we see in the market and how they're investing. John, over to you.
Yeah, thanks, Boz. I think that research definitely backs up a lot of what we're hearing and some of the conversations that we're having, which is that there's really intense business pressure from consumers and stakeholders across a lot of different industries. And that's the real impetus, rather than some kind of climate enlightenment or regulatory changes, which is good and bad. As you mentioned, it could fall back onto the back burner, but it also means that it's aligning closer with business priorities. But either way, we've seen a lot of movement from the services vendors to start to position their offerings around the sustainability space, particularly as it relates to decarbonization. The Big Four, for example, they're really driving discussions and they're well positioned around the new regulatory and reporting as some new proposals are evolving from the SEC and the European Commission as well, and also in areas like supply chain. And then there are strategy firms that are really seeing good opportunities to, help clients establish the right KPIs and work on the business strategy of integrating sustainability into your overall business model. And the integrators as well, they're continuing to align with some software partners, implementing the right reporting and the tracking systems, and also, helping clients improve their data center efficiency. So really, I think the thing that emerges from this is that no vendor can do it all. So very similar just to what we've been saying with the IT services market in general, and that collaboration and technology innovation is really necessary. And one example I want to pull that also kind of ties together the blockchain conversation. And I know that blockchain being an agent for sustainability is sort of an oxymoron right now. There's obviously a huge conversation around the energy that it uses. But I want to talk about something that KPMG is doing. We wrote about it. I think Patrick mentioned it at the beginning. You can read it, a special report on KPMG impact. And really what they're spearheading here is a project called Net Zero Equity. It's kind of similar to war bonds and crowdsourcing. It's a project that looks to gather small investments, but on a large scale, from everyday people and individuals that want to put their money towards a tangible climate mitigation project. And so KPMG here is trying to act not just as a thought leader, but also a solution architect. And they want to bring together enterprises, their technology partners, and like I said, everyday people to invest in projects that that help mitigate the climate crisis. And some things like building a solar farm or funding carbon carbon removal research, among a bunch of other areas. But the main issue here is that KPMG is still a centralized organization, and there's a layer of trust that needs to be established in order for people to buy in. And so that's where KPMG is hoping to use blockchain to kind of bridge that gap, to implement full visibility into where funds are going and also the return, because it is an investment. But of course, it requires a big ecosystem of stakeholders to do it. KPMG is not doing it alone. They're leaning on technology and integration partners, as well as project management, construction, and individuals to make it happen. So, we see a big opportunity for other service providers to really demonstrate their role, like as a community shepherd, like what KPMG is doing here, and to engage in some broader climate work, bringing their own niche capabilities and their own scale and resources to the table.
Excellent. Thanks, John. And I want to point out two things before we leave sustainability. One is we were having a conversation yesterday with somebody in one of the big four firms who said something that that I find myself saying whenever I talk about sustainability, and that's the imperative to sustain sustainability, which just sounds goofy when you say it, but it really is one of the most important parts of it. As Boz pointed out, we have had sort of waves in the past where sustainability and environment and all that was highly a high priority, and then it sort of faded. So what can be done to sustain all these efforts around sustainability and decarbonization? And I think John pointed out the critical no vendor can do it all. And more importantly when we think about no vendor can do it all, we tend to think at TBR about the space that we're looking at, and the IT services vendors and the consultancies and their technology partners and what they can bring to the table. But again, as John pointed out, it really does start to go beyond that. And it really means understanding that expanding what an ecosystem means is going to be part of this sort of global effort to sustain sustainability. So with that, we're finally going to jump to some IT-specific services vendors and what's happening with some of those trends. So we have to point out here, 2020, there was this big slide in 2020, and then there was this big boom in 2021. Both very much anomalies. This market has had relatively modest movement for years and years and years. I mean, we've seen little ticks up and little ticks down in terms of the amount of change and the amount of growth. So this 2020 and 2021 were anomalies. We're different. Obviously, it was the pandemic. And in thinking through sort of as we look at this side of, hopefully, knock on wood, the pandemic, what is it that really made the huge difference? I want to call attention to a couple specific things I think really drove what we see here, this little roller coaster move. Probably kind of obvious, but I think it's worth recalling because we're looking at it now from a May 2022 perspective, not a December 19 perspective. So to go back then, first in December 2019, the worry that we were hearing about from IT services vendors and consultancies was the potential for a global recession and how that could dampen demand. So what happened? Yeah, demand dampened for a totally different reason. But it turned out that the vendors that have been thinking about what it would mean if demand fell off a cliff, those vendors were prepared for the disruption and they did better. That's probably not surprising, but it really is still important to understand that there were vendors who were prepared for what happened, even if nobody could really see a global pandemic coming in the way that it came. I know some people did, but anyway. Second, the needs that enterprises had pre-pandemic, those needs got delayed, but they didn't go away. So again, the vendors who were able to maintain their people critically, their capabilities, their scale throughout the worst of the pandemic were then in a better position to deliver on where we are now on the other side of it. Again, that's kind of obvious, but it's really important to put that in perspective, that that's not what people were thinking about, especially in those early months of 2020. The people, the capabilities, the scale, that all required leadership, required patience, and it required, honestly, a financially strong enough position to make it through to where we are today. So with that, that's sort of the super big picture. Let's talk to some of the trends. And here, you can read them. And honestly, if you have questions specifically about them or you want to disagree with them, happy to hear that in the Q&A section. To take the first one, M&A activity was quiet in 2020 for obvious reasons. Been relatively tame, or was relatively tame in 2021, with that one big exception of IBM's move to split off and to have Kyndryl. I highly recommend reading Elitsa Bekalova's special report on Kyndryl that published on Monday. I think it was Monday. That special report, as she has told us, was one of the hardest ones she's had to write, because it was talking about a company that was born live, born now, born as an important part in the market. You're going to see in a second exactly how important in the market it is. So, and on M&A, I'd recommend keeping an eye out for some additional big moves in 2022, particularly as the tech-driven IT services vendors look to add more consulting capabilities at the same time that hyperscalers are looking to expand their service offerings. There's too much demand, too much pent-up demand for change in this market for this to be another quiet year. The second trend, and we'll get Boz to say a little bit about Infosys and EY on this particular trend in a moment, but what we're really seeing is a continuation of something that started pre-pandemic, as both IT services vendors and consultancies and their technology alliance partners started to reevaluate what they really wanted out of their partnerships. And the key thing to watch for here is a shift from what had been called vendor agnostic, which none of us ever liked, to something closer to exclusivity, and not complete exclusivity. That simply can't happen, but more tightly bound consultancies, IT services vendors, and hyperscalers or their software vendors looking to create really truly end-to-end alliances that actually fully embrace and fully serve their largest clients. All right, that's enough for me. Let's go to Kelly to hear on this last trend before we get to the big bubble chart. Kelly?
Thanks, Patrick. So on this last trend here, we really want to take a look at some of the workforce changes and how the vendors have evolved, some of the practices that they've been employing with their talent, and also how they're shifting their approach to resource management in general. So as we're looking at a lot of the services vendors, IT services is a people-driven business, and so vendors that are able to employ some of these more emerging tactics to kind of enhance the cultures, promote the collaboration, promote training, they're definitely going to be the ones that are more successful in alleviating attrition. As we've seen, attrition for a lot of the vendors kind of hit the highest point for some vendors during this past year. And so they've kind of looked internally to change some of that, change some of the ways that they work with their employees, the way that they structure their resource pyramids, as well as even some of the role definitions. And looking at the attrition, looking forward, attrition is still going to be a challenge for some vendors, particularly the ones that are struggling to create effective resource strategies and keep their employees engaged. But the shifting market conditions could also help improve the outlook for some of these vendors and extend the tenure of the employees, where it had been kind of quick. They were losing a lot of high level as well as lower level employees. Some of these market shifts could help them keep those employees a bit longer, even some of the newer ones. The labor market has kind of favored workers over the past year due to the economy and the demand around technology, but as Patrick kind of alluded to before, where the outlook is uncertain for 2022 around some of the political conflicts, the shifts in monetary policies, we could see a change in employee attrition where it's coming down as the opportunities aren't as available as they were this year and the past few years. We expect that a lot of the vendors will apply a lot of these lessons that they've learned to kind of continue the learning and not just stop at this point, to create a more continual process of learning and just kind of mix things up. We've also seen, and this is kind of on a different note, the vendors are finding different ways to actually incorporate talent and to acquire talent. I just had two quick examples I wanted to call out because I think they're worth noting. And the first one is the Hdl French Apprenticeship program. This is something different that we've seen from some of the vendors. So they're creating a multi-year apprenticeship program for students, college students mostly, where they're hoping to train them around IT services and science fields Something that's different about this program is upon completion of the program, they're not requiring that employees sign on with the firm full time. And while that is a risk for the company, it kind of shows the confidence that they have in the program and the culture of their company, that they don't need to require employees or candidates to stay on. They'll just choose to because they enjoyed the experience. And the last point I want to call out here was around hybrid and remote working. This is also something that's going to help facilitate that culture and the learning, where vendors are changing their approach to travel. They're not necessarily traveling as much as they were in the past, and they're more flexible in providing their employees with the requirement or option to travel. It'll definitely help to contribute to that work-life balance, going back to that culture and the learning. So definitely something that we'll see a bit more. It's just kind of where a lot of vendors had moved away from. During the pandemic, it was focused on the people, and then they kind of moved back to the focus on the business. I think finding a balance between that is definitely something we will see as we move through 2022. And with that, I believe I hand it back to Patrick.
Thanks, Kelly. Now, I want to emphasize something Kelly said, because I think it's wicked important. And if you didn't hear this, let me say it again. HDLT's program, where they're paying for 4 years of college for someone to get a STEM degree, comes with no commitment to work for HCL at the end of that 4 years. Every time I talk to somebody about that, and I'm a parent with kids in college, or one in college now, it's just unbelievable. People just don't believe it. I think it's really an amazing commitment, or a sense of belief in the company, that their culture is so strong that they can take that risk and make that bet. That's one. The other thing I want to point out, the training aspect, we definitely saw where training was sort of put on the back burner a bit during 2021. I think is at least the beginning of 2021, as a lot of companies tried to ramp back up to meet that demand that we talked about in the last slide. We're definitely hearing it. Every single conversation we're having now talks about training. Part of that is a reflection of what the attrition that was mentioned as well by Kelly. So I think that's important to keep in mind, is that we're going to see an emphasis on training going forward. So with that, let's go to the famous TBR bubble chart. This is right from our latest IT services benchmark. Quick orientation: the size of the bubble is revenue, the horizontal axis is growth, the vertical axis is operating margin. When we do readouts for clients, we often spend the entire time on this slide, diving into every vendor's performance and relative positioning. We're going to examine a few specific vendors on this today, starting with emphasis as I promised. But I want to pause here for a moment. I almost feel like I should take 10 seconds, but I'm not going to, and I'm not going to stop talking. But if you have questions about why a vendor on this shows up where they do, put those questions in the box. We can come back and to this slide at the end, and we can talk through it. Be happy to do that. There are a lot of vendors on here. I appreciate that, but that's straight out of our IT services benchmark. So with that, let's go to Boaz.
All right, so maybe just a quick overview on Infosys specifically and why they are where they are, right? So the company has come up from like 3-4 year now program that has really helped them to turn the tide in terms of their performance and where they are. I think a lot of it has come to the leadership vision and the investments being timely, being executed to their strengths. The cloud performance is a big part of it. Really staying within their own swim lane on the execution side. It's an important factor, and Patrick mentioned a moment ago about the EY and Infosys kind of a partnership that was recently announced. That's a formalization of an ongoing relationship between the two. And we see that as a pretty strong indicator how Infosys sees itself, rather than trying to branching out in different areas that maybe not known for or don't have enough depth, but rather than just forming a partnership with the one like with the EY that can actually use that relationship and use that name as a as a door opener and trying to really support each other essentially, because we know at the same time EY doesn't have the same scale, doesn't have the same execution and technology capabilities that Infosys brings with 4 decades of experience. So it's an important factor to look forward how the performance will continue. Like I said, cloud has been a big factor, analytics, cybersecurity, execution, and really managing its culture really well in the last 3 years that have helped them to rebound and really expand their wallet share. Certainly several mega deals. Their large accounts have expanded. They had about 20 clients in the $100 million category back in 2018. Now they're up to 38. So in 4 years, they added 18. They basically doubled their roster of 100 million plus accounts. Their large deals are something that they really focus on and really trying to expand wallet share as much as possible. One thing I want to highlight here is as a speculative thought further, in addition to kind of watching how Infosys updates its performance as a result of the relationship with EY, will be what if Infosys and Kyndryl decide to marry each other, so to speak. In a way of like, okay, no, Kyndryl is just a new company, but looking at those two companies, there's actually a huge complementary opportunity between each one's portfolio. So Infosys ITO business, which the way we estimate is about $1.5 billion. Kyndryl, it's about $15 billion. So that's the majority of Kyndryl's business, right? So if you think about it, if you put those two together, you're looking at about over $34 billion company. A massive move, not unheard of, but certainly will move Infosys into, or whatever the new company might be called, into really a number 2 spot in terms of revenue size, and really challenge, what does that mean to Accenture? What does that mean to TCS in terms of overall revenue size? The closest next in terms of ITO size, we know DXC has 8.2 billion in ITO. Atos has 6.1 billion in ITO. One would say, why would anyone want to invest in a legacy ITO business? Well, great, cloud is great. It drives a lot of the new opportunities right now, but there is still a ton of mainframe migration opportunities. There's still a ton of like infrastructure managed services that there are still a lot of legacy workload that needs to be captured before can be really like all about cloud and all about like new technology, so to speak. So there's still a massive opportunity that could create and could potentially, spark the interest of a potential marriage like between Infosys and Kyndryl. Would that happen? We don't know. It's just a purely speculative thought. But what if? And certainly will be something will make our jobs even more interesting, and we'll get more questions about it. So with that, I'll turn it over to John and Kelly.
Thanks, Buzz. Yeah, that would be a wild shakeup. But I'll talk about TCS now and some of the things that they've been doing. Recently they did become the second largest vendor in our IT services benchmark in terms of revenue following that spinoff of Kyndryl. But also in our 4Q21 benchmark, it was TCS was number 8 in year-to-year growth and number 3 in operating margin. So overall, they're really doing quite well in the market, and there's a number of reasons for this that we've talked about, but a lot of the drivers are continuing. One of them being kind of the overall demand for outsourcing really is still there since the beginning of the pandemic, as well as the demand for cloud migration, as Boz was getting into, and the application modernization. That's put TCS and a lot of its India-centric peers in a really good position to win some new deals and to expand on client wallet share, provided that they can keep up on the supply side, which has really turned out to be very challenging with so much movement in the labor market lately. I'd say, though, that TCS so far has managed it to an extent, better than some of its peers. It's got a below average attrition rate, I think 17 for this quarter, and compared to some of its other vendors that are well over 20%, nearing 30%. I think Cognizant is even over 30%. But one of the biggest changes that we've witnessed with TCS is around its partner ecosystem. Since 2020, it heavily invested in a partner-trained talent with Microsoft and SAP and other technologies. It launched 3 cloud business units around the big 3, Azure, AWS, and Google. And we've even heard from some smaller partners, and they've won some awards that, TCS is bringing some more resources to the table and looking for other ways to collaborate. And that has paid dividends. The company is one of the largest partners for migrating clients over to Azure. And the business units and the deepened relationships have really helped TCS in another way, which is to innovate by co-developing solutions, being able to tap into their partners' resources and jointly go to market in certain industries and also even in geographies. So a couple a couple examples emerged last quarter that really centered on APAC. There were several new partnerships with universities and some other organizations. For instance, the Institute of Technical Education in Singapore, it collaborated with that education organization, specifically around developing some internships, training pipelines, and also education courses. They also partnered with the National University of Singapore, this time working together to create a ESG data collection and assessment framework. And it also worked with a Thailand-based telecom company, AIS, to market its smart city and manufacturing solutions alongside that telco's network offerings. So it's combining forces with a lot of different players, and that's really improving its value proposition as their clients are no longer just in survival mode from the pandemic, but they're really looking at growth and innovation as well. And TCS landed a couple $1 billion mega deals that kind of speaks to its scale as well. That was last quarter, and excluding those, it had record bookings. So, I think what we're seeing right now is that its scale and its offerings are really resonating, and it's in a good position to kind of maintain that momentum entering 2022.
So looking on the other end of the chart, I wanted to call out Fujitsu. In March, Fujitsu had unveiled a plan to restructure its HR management structure. And so this was kind of coming from a lot of their investments around their culture, evolving their talent, and creating more of a global perspective, so integrating its Japan operations more heavily within its operations throughout the globe. So looking more at the restructuring, Fujitsu had centered the plan around 3 different pillars, which includes operations, collaboration, and learning and growth. So the reason for the segmenting of the pillars was more to help involve the employees in more collaboration, have them working more closely together to help lead to growth opportunities that allow them to evolve their career paths and kind of progress throughout the organization. A shift for the firm specifically throughout this new plan focuses more on the positions. So the positions that are created and in place will reflect the company's business strategy. So it wouldn't just be a position for the sake of having the position. It's more focused around the goals of the firm and where they're going. And it's also heavily based on the responsibilities and what exactly the roles will be reflecting. And that's a shift for the firm to help them kind of evolve and really integrate a lot of the newer areas of sustainability that John was talking about, some of those efforts more heavily throughout the talent and throughout its client engagements. As part of its plan as well, Fujitsu is also focusing on training. So the firm will implement a training program. It's called On-Demand Learning. And so through that platform, it provides users with videos, different conversational tools, autonomous learning capabilities to help the user kind of evolve alongside the company. So they're able to work with their colleagues to share their experiences, but also letting them learn at their own pace. So kind of using a mix of both the platform learning as well as some of that more conversational learning. So transforming its resource management and allowing for this more flexible learning path as well as individual responsibilities is helping Fujitsu to develop a talent bench that's better equipped to drive some of these technology transformations. And as I had mentioned, it kind of follows their previous efforts to enhance their culture. As we've been talking about a lot on the webinar, the vendors are really looking to evolve both their talent and their culture, and so all of these things come together. While Fujitsu does also look to expand their ecosystem, I think, again, as it's a services business, a lot of it comes within, so starting there and then moving outward is going to help these vendors to progress. With that, I'll hand it over to Boz.
Actually, back to me, but that's okay. It's funny, Kelly, the whole thing around people. So services, even IT services is still a people business. It's still delivered by people, run by people, and delivered to people. So getting the people part of it right, getting the culture right, getting the management of people right really is critical. So I think it's easy to look at this bubble chart and not be super positive about where Fujitsu is, but Fujitsu is worried about making sure that, or working on getting the people part of their equation in the right place, and that's what actually is going to lead to growth and helping them move into a different position on this bubble chart. So we're going to wrap it up here. I just want to share a couple more slides. I want to show this is our digital transformation portfolio. It's a monthly deliverable. Boss has mentioned blockchain. That came out in October, and then again in April. We also cover sort of everything else you can see right here. I think we're right in the middle of voice of the customer right now. So that means going out and both surveying customers, but also talking to people who are responsible for digital transformation at their enterprise. And of course, we're talking to them about not just what they're doing, but also who they're working with. Why did you choose to work with this particular consultancy? Why are you working with this IT services vendor? Why are you choosing this particular cloud vendor? So those conversations are going on now, and that report will come out at the end of the month. And then, of course, we've been talking about IT services. This is the IT services benchmark coverage. In case you couldn't read all the companies on that bubble chart, there they are in the middle column. Also want to make sure everyone understands we are coming at this with not just a lot of opinion, but there are all those metrics there. We do look at all the different ways that we can break down these companies and understand what their performance has been. And then TBR's basic mission is look at a company's strategy, look at their performance, do those two things make sense. And then one more thing I want to share, because we did talk about sustainability. This was our commitment to sustainability. We went out and did a beach cleanup day this morning here in Hampton. And if you're really tuned into this webinar and you've been anticipating it for weeks now, you may have seen that Elitsa Bekalova and Evan Wallacott were both on the invitation for this webinar, and they were supposed to speak. Elitsa is at the beach in the Black Sea, and Evan is at the beach on Cape Cod, Massachusetts. So they're sort of with us in spirit, at least on the beach cleanup, not with us in spirit when it comes to actually delivering this webinar for everybody. So with that, I want to take on a couple of questions, and let me pull up one right away. And it's a good one, and it's on blockchain. And Boaz, this is going to have to be for you. Blockchain's unique value is decentralization and the associated implied trust. A private blockchain is just a database. In that case, what value proposition offsets the overhead and complexity of blockchain? Boaz?
That's a good question. I mean, it's certainly a question we are trying to wrap our heads around when we talk to buyers, specifically because, as we talked earlier, you know, blockchain has seen its fair share of being in the winter, kind of like, you know, and in the darkness. And like, why would I invest in one more technology? Because, as you pointed out, it could be done with other technologies. And as a result, what we start seeing, and we were hinting earlier in the presentation, that Ethereum, like public blockchain, is certainly the better. There's more value in public blockchain as long as vendors and the developers are able to address the privacy issue, and obviously the green issue, the gas piece, and so forth. So, in terms of able to set it up in a way that the trust is there, as if you are using a private kind of like permissioned blockchain essentially. When it comes to the private, because the private is about permission blockchain. So if you want to use the best of both worlds, let's put it this way. But we're a long way to go. We know there's some discussions. There's the permission protocols are being changed. The consensus protocols are being changed. But it's about understanding how much you can do, how much you can optimize, and in terms of processes, and how much you can develop in terms of automation, or the use cases around supply chain. We've heard finance, we've heard it. But it's like, what else can it be done? And those use cases, developing those use cases will fall into the vendors' ability to develop those use cases. I guess one way to think about it. Again, trying to build up best of both worlds is the way to go. I'm still kind of like bullish on what might happen. Just because of the technology is evolving. And it's there's enough hype around Web3 and Metaverse. I think will drive some more of a advancement from a technology perspective to make public blockchain pick up the benefits of private and be still used in a kind of like in an enterprise setting.
Yeah, the only other thing I would add to that, I think the person who asked this question is right. A private blockchain is just a database if that private blockchain is not beyond the enterprise. And in order to get beyond the enterprise, of course, a private blockchain has to be permission blockchain, like Boaz said. So I think that's where, because you don't want to have just a more expensive database running in parallel, another set of processes that you have to manage and govern, just so that you can say you have a blockchain. So I totally understand that, and I think that gets back to where it's not the technology, it's people. It's people being willing to trust and people being willing to adopt and adapt to new technologies. Boaz, your answer kind of anticipated the next question in here, which is, can you talk about where metaverse fits into your picture of the IT services future? Well, the IT services future.
Yeah. Well, we have had internal debates around the metaverse, no doubt about it. Many of us have their own opinions, and they're complete opposite. Some of them are closer than others. Others are very far apart. Where we see it is, there's a couple of opportunities we see. One is the way the digital marketing sprout, like about 7-10 years ago, and the idea of like e-commerce and really about improving customer experience and whatnot. That's definitely, it's a potential there, and the opportunity around developing direct-to-avatars campaigns and trying to think about who's in the metaverse and what is the value that metaverse brings. So I think the advertisers and the marketers will see that immediate opportunity, but they'll need the support from the IT side to be able to develop the right applications, the right interface, the right user experience, as well as the proper governance to be able to bring an experience out of the physical, from the virtual world back to the physical world, so someone can continue the transaction, have the same experience. So advertising and marketing is certainly more of a low-hanging fruit at this point. Digital twin, certainly a greater, more tangible B2B type of opportunity. We start seeing some use cases being built up as a result of using AR and VR, which I think is more of a kind of like an entry point for the metaverse. But again, a lot of hype at this stage. Certainly a great use case for blockchain, no questions about that. There's a lot of enablement that will be required and needed, but yeah, marketing and advertising are probably the most immediate ones we see.
Yeah, and I intentionally did not, like I normally do, I switch around to another screen or another slide that we've already covered. I intentionally left that up there so you can see what my thought is about the metaverse. You can see it right there. All those people standing on a beach. That is not the metaverse. One last question that came in. Have IT services firms discussed their respective Web3 strategies? Some of the consultancies have. We've had some conversations, particularly with big four firms who have talked about what they're trying to do around Web3. I think it's as nascent as blockchain was a few years ago, as metaverse is now. I think it's it's something that, if anything, it's going to be folded into the way that a lot of these IT services vendors try to, this is a word I hate as much as I hate the word journey. Thanks, Boaz, for saying journey earlier. I think it's a way that vendors are going to try and differentiate, and it will be a meaningless way to try and differentiate because nobody knows exactly what Web3 is actually going to bring to the table until we start to see some use cases that scale. That's what it always comes back to. Ecosystems, use cases at scale, and then, again, people. And getting people to not be the problem anymore. Or what did you call them? Unsteady. Making people steady instead of unsteady. Yeah. All right, with that, we have gone over the hour. Thank you all very much for participating in this. We really appreciate it. Thank you to my colleagues for being involved. Haley, do we need to say anything else before we go? We're all set. Thank you very much. Take care.